Listen carefully, because what I'm about to share with you is something the mainstream financial media won't touch with a 10-foot pole. And there's a very specific reason why they're staying silent. But before we get into that, I need you to understand something fundamental. We are living through one of the most significant monetary transitions in modern history, and most people have absolutely no idea it's happening right under their noses. Right now, as you're watching this, there's a 72-hour window that's quietly closing. Not because of some arbitrary deadline I'm making up, but because of a convergence of events that happens maybe once or twice in a lifetime. And if you're holding gold, or if you've been thinking about protecting your wealth with precious metals, the decisions you make in the next few days could determine whether you preserve your purchasing power or watch it evaporate like morning fog. Let me paint you a picture of what's actually happening right now in the gold market, because this isn't just about price movements or technical charts. This is about a fundamental restructuring of the global financial system, and gold is sitting right at the center of it. 3 days ago, something extraordinary happened that barely made a ripple in the financial news. The COMEX gold warehouse stocks dropped by 847,000 ounces in a single session. Now, if you're not familiar with how the gold market works, let me explain why this matters. The COMEX is where the paper gold market operates, where futures contracts are traded, where the price discovery happens that affects every gold transaction on the planet. And when physical gold starts leaving those warehouses at this pace, it's telling us something critical. There's a massive disconnect between the paper price and the physical reality. But here's where it gets really interesting. At the same time this is happening, we're seeing something unprecedented in the central bank world. In the last quarter alone, central banks added 337 tons of gold to their reserves. That's the highest quarterly purchase in over a decade. And it's not just any central banks. We're talking about China, Russia, India, Turkey, Poland. These aren't random countries making random decisions. These are nations that are actively, deliberately, systematically moving away from dollar dependence. Now I want you to think about this for a moment. Why would central banks, the most sophisticated financial institutions on the planet, with access to information and analysis that you and I can only dream about, why would they be buying gold at near record prices? They're not doing this because they think gold is going to go up 10 or 20%. They're doing this because they know something about the future of the monetary system that hasn't fully played out yet. Let me take you back to 1971 for a second, because history doesn't repeat, but it sure does rhyme. August 15th, 1971, President Nixon closes the gold window. The dollar is no longer convertible to gold. The Bretton Woods system collapses. And you know what happened next? For the next 9 years, gold went from $35 an ounce to $850 an ounce. That's a 2,300% increase. But here's what most people don't understand about that period. It wasn't just about the price going up. It was about a complete restructuring of how money worked globally. The people who understood what was happening in 1971, who saw the writing on the wall, who moved their wealth into hard assets, they didn't just preserve their purchasing power, they multiplied it many times over. The people who stayed in cash, who trusted that the government and the Federal Reserve had everything under control, they watched their savings get absolutely decimated by inflation. And right now, we're seeing the exact same pattern, but on a much larger scale. The difference is, in 1971, the dollar was still the undisputed global reserve currency. Today, that dominance is being actively challenged. The BRICS nations, representing nearly half the world's population, are building alternative payment systems. They're settling trade in their own currencies. They're accumulating gold at a pace we've never seen before. Just last month, the BRICS summit in Kazan, Russia, made announcements that should have been front-page news everywhere. They're launching a new payment system that bypasses SWIFT entirely. They're discussing a commodity-backed trading currency. And at the center of all of this, backing all of these initiatives, is gold. Physical gold. Not paper promises, not derivatives, not ETFs. Actual metal in actual vaults. Now here's where this 72-hour window comes in, and why timing matters so much right now. We're approaching a critical technical level in the gold market. Gold is currently trading around $2,650 an ounce, and it's consolidating right below the all-time high of $2,685. But more importantly, we're seeing a massive buildup in the options market. There are enormous call option positions expiring this Friday at the $2,700 strike price. What this means in practical terms is that if gold breaks above $2,700 before Friday's close, we're likely to see a cascade of buying that could push prices significantly higher very quickly. This is what traders call a gamma squeeze. The market makers who sold those call options will need to buy physical gold or futures contracts to hedge their positions, which drives the price higher, which triggers more buying, which creates a feedback loop. But here's the thing that makes this moment so critical. This isn't just a technical setup. This is happening against a backdrop of unprecedented physical demand and tightening supply. The Shanghai Gold Exchange, which is the world's largest physical gold exchange, is showing premiums over the London spot price that we haven't seen in years. That premium tells us that in Asia, where most of the world's gold demand originates, people are willing to pay more than the official price just to get their hands on physical metal. Let me tell you a story that illustrates what's really happening on the ground level. I was talking to a dealer in Singapore last week, someone who's been in the precious metals business for 30 years. He told me something that should concern every gold holder. He said that for the first time in his career, he's seeing consistent delays in getting large orders filled. Not because of logistics, not because of shipping problems, but because the refineries are running at full capacity and still can't keep up with demand. Think about what that means. The refineries that turn large gold bars into smaller bars and coins, they're working around the clock, and they still have a backlog. This is happening while the paper price of gold is barely moving. This is happening while the mainstream financial media is telling everyone that gold is just a barbarous relic, that crypto is the future, that stocks only go up. There's a massive disconnect here, and that disconnect is creating an opportunity that won't last. Because eventually, the paper price and the physical reality have to converge. They always do. And when they do, the adjustment is usually violent and sudden. Now, I want to talk about something that's particularly relevant if you're thinking about your retirement security. Because this isn't just about making money on a trade. This is about preserving the wealth you've spent your entire life building. And there's a specific strategy that a lot of sophisticated investors are using right now that most people don't even know exists. Quick aside here, and this is important if you have significant retirement savings. If you're sitting on $100,000 or more in traditional retirement accounts, IRAs, 401ks, there's a way to get physical gold into those accounts without triggering taxes or penalties. I put together a comprehensive guide on how gold IRAs actually work, the rules, the process, the things to watch out for. It's completely free, and you'll find it in the description below. It's worth looking at if you're concerned about protecting your retirement savings from what's coming. No pressure, but it's there if you want it. All right, back to what's happening in the market right now, because this gets even more interesting. Let's talk about the supply side of the equation, because this is where things get really concerning for anyone who's not already positioned in gold. Global gold mine production peaked in 2018. Since then, it's been essentially flat or declining slightly. And this isn't because miners don't want to produce more gold. It's because the easy gold has already been found and mined. The ore grades are declining. The costs are increasing. The time from discovery to production is getting longer. We're talking 10 to 15 years now from when you find a deposit to when you're actually pulling gold out of the ground. Meanwhile, demand is exploding. Not just from central banks, although that's a huge factor, but from individual investors, from industrial users, from jewelry demand in Asia. India alone imports over 800 tons of gold per year. China's demand is even higher, and it's growing. So we have declining supply, increasing demand, and a paper market that's pretending none of this matters. That's not a sustainable situation. Something has to give. And when it does, the people who waited too long are going to find themselves in a very difficult position. Let me give you another historical parallel, because this is important. In 2008, during the financial crisis, there was a brief moment when gold actually dropped in price. It went from around $1,000 an ounce down to $700. And you know what happened? People panicked. They sold. They thought gold had failed as a safe haven. But the smart money, the people who understood what was really happening, they backed up the truck and bought everything they could get their hands on. Because they understood that the drop wasn't about gold losing value. It was about a liquidity crisis forcing people to sell anything they could to raise cash. And sure enough, within 6 months, gold was back above $1,000. Within 3 years, it hit $1,900. The people who sold at $700 missed one of the greatest wealth preservation opportunities in modern history. Right now, we're not in a crisis moment like 2008, but we're in something potentially more significant. We're in a slow-motion restructuring of the entire global monetary system. And the thing about slow-motion crises is that they give you time to prepare, but they also lull you into complacency. You keep thinking you have more time. You keep waiting for a better entry point. And then suddenly, the window closes, and you realize you waited too long. Let me tell you what's happening with the US dollar right now, because this is the other side of the gold equation. The dollar index, which measures the dollar against a basket of other currencies, has been remarkably stable. On the surface, everything looks fine, but underneath, there are cracks forming that are getting harder to ignore. The US national debt just crossed $36 trillion. That's trillion, with a T. The interest payments on that debt are now over $1 trillion per year. That's more than we spend on defense, more than we spend on Medicare. And it's growing exponentially because we're borrowing money to pay the interest on the money we already borrowed. Now, the standard response to this is that it doesn't matter because the dollar is the reserve currency. We can print as much as we need. The world has to accept dollars because that's how international trade works. And that's been true for the last 50 years. But it's not true anymore. Saudi Arabia, which has been the cornerstone of the petrodollar system since 1974, just announced they're open to settling oil sales in currencies other than dollars. That's not a small thing. That's a fundamental shift in how the global energy market operates. And energy is the foundation of everything. Every product you buy, every service you use, it all requires energy. And if energy is no longer priced exclusively in dollars, then the demand for dollars drops significantly. What does that mean for you? It means that the dollars you're holding, the dollars in your bank account, the dollars in your money market fund, they're going to buy less. Not because of normal inflation, but because of a structural shift in global demand for dollars. And this is where gold comes in. Because gold doesn't have counterparty risk. It's not someone else's liability. It doesn't depend on a government's promise or a central bank's credibility. It's just metal. It's been money for 5,000 years, and it will still be money long after every fiat currency in existence today has gone to zero. Now, I want to address something that I hear all the time from people who are skeptical about gold. They say, gold doesn't pay interest. It doesn't generate cash flow. It just sits there. And that's absolutely true. Gold doesn't pay interest. But you know what else doesn't pay interest? The cash that's losing purchasing power in your bank account. The difference is, gold maintains its purchasing power over time. Cash doesn't. Let me give you a concrete example. In 1971, when Nixon closed the gold window, the average house in America cost about $25,000. Gold was $35 an ounce. So you needed about 714 ounces of gold to buy a house. Today, the average house costs about $400,000. Gold is around $2,650 an ounce. So you need about 151 ounces of gold to buy a house. In other words, if you held your wealth in gold over that period, you could buy almost 5 times as many houses today as you could in 1971. If you held your wealth in dollars, you'd need 16 times as many dollars to buy the same house. That's the difference between a hard asset and a depreciating currency. But here's what makes this moment so critical. We're not just seeing a continuation of the trends that have been in place for the last 50 years. We're seeing an acceleration. We're seeing a phase change. And phase changes happen quickly. They happen when everyone suddenly realizes at the same time that the old rules don't apply anymore. Think about what happened in March 2020 when COVID hit. The stock market dropped 35% in 3 weeks. 3 weeks. Years of gains wiped out in less than a month. And the people who were prepared, who had some of their wealth in hard assets, they were able to weather that storm. The people who were 100% in stocks, who believed that diversification meant owning different stocks, they got crushed. Now, I'm not saying we're about to see a stock market crash. I'm saying that we're in an environment where unexpected things can happen very quickly. And in that kind of environment, having some of your wealth in an asset that's not correlated to stocks, that's not dependent on the financial system, that's been a store of value for thousands of years, that's not just smart, that's essential. Let me tell you about what's happening in the ETF market right now, because this is another piece of the puzzle. The gold ETFs, the paper gold products that trade on stock exchanges, They've been seeing outflows for months. People have been selling their ETF shares. And on the surface, that looks bearish for gold. But here's what's actually happening. That gold is leaving the ETFs and going into physical form. People are taking delivery. They're moving metal out of the system and into private storage. Why would they do that? Because they're worried about counterparty risk. They're worried that in a real crisis, the ETF might not actually have all the gold it claims to have. They're worried about the difference between owning a claim on gold and owning actual gold. And those are legitimate concerns. The gold market is highly leveraged. For every ounce of physical gold that exists, there are probably 100 ounces of paper claims on that gold. Futures contracts, options, ETFs, unallocated accounts. All of these are claims on gold that may or may not be backed by actual metal. And as long as everyone doesn't try to take delivery at the same time, the system works fine. But if there's ever a rush for physical metal, if everyone suddenly wants to convert their paper claims into actual gold, the system breaks down very quickly. We saw a preview of this in March 2020. The gold futures market nearly broke. The spread between the futures price and the physical price blew out to over $100 an ounce. Refineries were shut down. Transportation was disrupted. And suddenly, people who thought they could easily convert their paper gold into physical gold found out that it wasn't so easy after all. That was a temporary disruption. But what we're seeing now is a structural shift. The physical gold is moving from west to east, from the COMEX warehouses to Shanghai, from London to Singapore, from ETFs to private vaults. And once that gold leaves the Western financial system, it's not coming back. China has been very clear about their strategy. They want to reduce their dependence on the dollar. They want to increase their gold reserves. And they're doing both simultaneously. Every month, the People's Bank of China reports adding more gold to their reserves. And those are just the official reserves. The actual amount of gold flowing into China is much higher when you include private purchases and gold that's being held off the official books. Why does this matter to you? Because it means that the available supply of gold in the Western markets is shrinking. And when supply shrinks and demand stays constant or increases, prices go up. It's basic economics. But more than that, it means that the ability to acquire physical gold at anywhere near the current paper price is going to become increasingly difficult. I want to share one more story with you, because I think it illustrates the psychology of what's happening right now. I have a friend who's a financial advisor, very successful, manages hundreds of millions of dollars for high net worth clients. And for years he's been telling his clients that gold is a waste of money, that they should be 100% in stocks and bonds, that gold is for doomsday preppers and conspiracy theorists. Last month, he called me, and he said something that shocked me. He said, "I think I've been wrong about gold." He'd been doing research, looking at what central banks are doing, looking at the debt levels, looking at the geopolitical situation. And he realized that the conventional wisdom he'd been following his entire career might not apply anymore. Now, he's not telling his clients to sell everything and buy gold, but he is recommending that they allocate 10 to 15% of their portfolios to precious metals. And you know what's interesting? His clients are doing it. These are people who've never owned an ounce of gold in their lives, but they're looking at the same data, seeing the same trends, and they're realizing that the world is changing in fundamental ways. This is how sentiment shifts happen. Slowly at first, then all at once. Right now, we're in the slowly at first phase. Most people still think gold is irrelevant. Most financial advisors still recommend against it. Most mainstream media outlets still mock gold bugs. But underneath the surface, the smart money is moving. The institutions are positioning. The central banks are accumulating. And when the shift happens, when the mainstream finally catches on, the price is going to move so fast that most people won't be able to react in time. They'll be chasing the price higher, paying premiums, dealing with delivery delays, wishing they'd acted when they had the chance. So here's what you need to understand about this 72-hour window. It's not that the world is going to end on Friday. It's not that gold is going to double overnight. It's that we're at a critical juncture where the technical setup, the fundamental backdrop, and the sentiment shift are all aligning at the same time. And when that happens, the opportunity to position yourself advantageously starts to close. If you're already holding gold, this is not the time to get shaken out. This is not the time to sell because you're worried about a short-term pullback. This is the time to understand that you're holding one of the few assets that's going to maintain its value through what's coming. If you're not holding gold yet, if you've been waiting for the perfect entry point, if you've been telling yourself you'll buy when it drops back to $2,500 or $2,400, you need to understand that that opportunity might not come. The market doesn't care about your ideal entry point. The market is going to do what it's going to do based on supply and demand. And right now, the supply and demand dynamics are pointing in one direction. The question you need to ask yourself is this: what's the cost of being wrong? If you buy gold now and the price drops 10%, you're down 10% on that portion of your portfolio. That's manageable. That's recoverable. But if you don't buy gold, and the monetary system goes through the kind of transition that all the evidence suggests is coming, the cost of being wrong is potentially catastrophic. This isn't about fear. This isn't about panic. This is about looking at the evidence objectively and making rational decisions based on that evidence. The central banks are buying gold at record levels. The BRICS nations are building alternative monetary systems backed by gold. The physical supply is tightening. The paper market is showing signs of stress. The dollar's reserve status is being challenged. The debt levels are unsustainable. These aren't conspiracy theories. These are facts. These are things that are happening right now, in real time, that you can verify for yourself. And the logical conclusion from these facts is that gold is going to play an increasingly important role in the global monetary system going forward. So what should you do? That's ultimately your decision, but I'll tell you what the smart money is doing. They're allocating a meaningful portion of their wealth to physical gold. Not paper gold, not gold stocks, not gold ETFs. Physical metal that they can hold, that they control, that doesn't depend on any counterparty. They're not trying to time the market perfectly. They're not waiting for a pullback. They're recognizing that we're in the early stages of a major monetary transition, and they're positioning themselves accordingly. They're thinking in terms of years and decades, not days and weeks. And they're doing it now, while there's still time, while the physical metal is still available at reasonable premiums, while the mainstream is still skeptical. Because they know that once everyone figures out what's happening, it will be too late to position yourself advantageously. The window is closing. Not because of some arbitrary deadline, but because the fundamentals are shifting, the technicals are setting up, and the sentiment is starting to turn. And when all three of those things align, the opportunity doesn't last long. So take a hard look at your situation. Look at your portfolio. Look at how much of your wealth is dependent on the continued stability of the current monetary system. And ask yourself if that's a risk you're comfortable taking. Because the evidence suggests that the current system is under more stress than at any time since 1971. And we all know how that turned out for the people who were prepared versus the people who weren't. The choice is yours. But the clock is ticking. And this window won't stay open forever.